$167 million. That's what Evergreen just paid for a single container ship. But here's what's going to blow your mind. These floating giants can generate over $15 million in revenue per single voyage. Today we're diving into the numbers that shipping companies desperately don't want you to see. How long does it actually take to pay off a $250 million investment? And can one trip around the world really make millions? The math is about to shock you. Let me paint you a picture that's going to change everything you think you know about global shipping. Right now, as I'm speaking, there are mega container ships crossing our oceans that cost more than some countries' entire annual budgets. We're talking about floating cities that dwarf skyscrapers. The Evergreen, one of the world's largest container ships, stretches 400 meters long. That's longer than the Empire State Building is tall. And it can carry 24,004 20-foot containers in a single voyage. But here's where it gets absolutely insane. According to recent industry data, these ships don't just transport goods, they're money-printing machines. A single Asia to Europe voyage can generate revenue exceeding $15 million. Let me break down exactly how this works. The most profitable shipping route in the world runs from Shanghai to Rotterdam. It's a 28-day round trip that covers over 24,000 nautical miles. On this route, shipping companies are currently charging between $2,800 and $3,400 per 40-foot container. Now here's the math that will blow your mind. A 20,000 TEU container ship, that's 20,000 20-foot equivalent units, can actually carry about 10,000 40-foot containers when fully loaded. 10,000 containers times $3,100 average rate equals $31 million in gross revenue per voyage. $31 million in 1 month. But wait, there's more. These ships don't make just one voyage per year. The most efficient operators complete 12 to 13 round trips annually. That's potentially $400 million in annual revenue from a single vessel. But revenue isn't profit, and this is where the real story gets interesting. Operating a container ship isn't cheap. Industry experts calculate that a large container ship costs between $50,000 and $85,000 per day to operate. This includes fuel, which represents about 46% of operating costs, crew salaries, insurance, maintenance, and port fees. Let's use $65,000 per day as our baseline. Over a 28-day voyage, that's $1.82 million in operating costs. So our $31 million voyage generates a gross profit of approximately $29.2 million. $29.2 million profit in 1 month. Now you're starting to see why shipping companies are willing to invest hundreds of millions in these vessels. But there's a catch that most people never consider. These numbers assume perfect conditions, full capacity, premium rates, no delays. Reality is much more complex. Container shipping is incredibly cyclical. During the COVID pandemic, rates skyrocketed to over $20,000 per container. Companies were printing money. But by 2023, rates had crashed to under $1,400 per container. Some shipping lines actually lost money on certain routes. This volatility is exactly why understanding the payback period is so critical. When Evergreen paid $267 million for their newest ship, they weren't just buying a vessel, they were making a calculated bet on global trade patterns, fuel costs, and economic cycles. The question is how long before that bet pays off. To understand this, we need to look at 3 real-world scenarios: the boom times when rates are sky-high, the normal times when markets are stable, and the bust times when companies fight for survival. Each scenario tells a completely different story about profitability and payback periods. In boom times, like we saw in 2021 and 2022, a single voyage could generate $50 to $80 million in revenue. Ships were literally paying for themselves in just a few years. But those golden periods don't last forever. Smart operators know they need to plan for the long haul. This brings us to the most important factor that determines whether a $267 million investment makes sense: route selection and operational efficiency. Not all shipping routes are created equal. The Asia-Europe route via Suez Canal generates different profits than the Asia-US West Coast route. The Trans-Pacific route is shorter, about 14 days, but container rates are different. Currently, Asia to US West Coast rates average around $1,725 per 40-foot container. That's roughly half the rate of the Europe route, but the shorter voyage time means more trips per year. A ship on the Trans-Pacific route might complete 18 to 20 round trips annually versus 12 to 13 on the Europe route. The math changes completely. And here's something that will surprise you: the most profitable ships aren't always the biggest ones. While 24,000 TEU giants grab headlines, many operators find that 15 to 20,000 TEU ships offer the best return on investment. They're large enough to achieve massive economies of scale, but small enough to access more ports and maintain schedule flexibility. These mid-sized giants currently cost around $210 million new. Slightly less investment, potentially better returns. But regardless of size, every container ship faces the same fundamental challenge. They must generate enough cash flow to cover not just operating expenses, but also debt service, depreciation, and provide a return to investors. This is where the real magic happens in the numbers, and it's where we'll discover the true payback period of these floating investments. Now here's where most people get it completely wrong when calculating container ship profitability. They only look at revenue and basic operating costs. But there's a hidden iceberg of expenses that can sink the entire investment. Let me show you the real math that shipping executives use behind closed doors. When Hapag-Lloyd committed $4 billion for 24 new container ships, they weren't just buying vessels. They were signing up for a 25-year financial commitment that goes far beyond the purchase price. First, let's talk about financing. Most shipping companies don't pay cash for these ships. According to maritime finance data, container ships are typically financed with 75 to 85% debt. So on our $267 million ship, the company puts down roughly $40 to $67 million. The remaining $200 to $227 million gets financed. Current maritime loan rates range from 4% to 7% annually, depending on the company's credit rating and market conditions. Let's use 5.5% as our baseline. Over a 15-year loan term, that's $1.67 million in annual interest payments. But wait, there's more. Ships don't last forever. The industry standard is to depreciate a container ship over 20 to 25 years. Using straight-line depreciation over 22 years, our $267 million ship loses $12.1 million in value annually. That's $33,000 every single day, whether the ship is sailing or sitting in port. Now let's add the real operating costs that most analysts miss. We talked about $65,000 per day in direct operating expenses. But there are indirect costs that are just as important. Insurance alone costs between $2 and $4 million annually for a large container ship. Hull and machinery insurance, protection and indemnity coverage, war risk insurance. In today's volatile world, with piracy, geopolitical tensions, and extreme weather events, insurance premiums have skyrocketed. Then there's crew costs. A modern container ship requires a crew of 20 to 25 professionals. Annual crew costs, including salaries, training, certification, and benefits, run between $3.5 and $5.5 million per year. And this assumes no crew shortages, which have become a major industry problem. Skilled maritime officers can command premium wages, driving costs even higher. Maintenance and dry docking represent another massive expense category. Every container ship must undergo mandatory dry dock inspections every 2.5 to 5 years. A single dry dock session for a large container ship costs between $8 and $15 million. This includes hull cleaning, painting, engine overhauls, and regulatory compliance upgrades. Between dry docks, ongoing maintenance costs average $2 to $3 million annually. But here's the cost that really separates profitable operators from struggling ones: fuel efficiency and route optimization. A large container ship burns between 200 and 300 tons of fuel per day. At current marine fuel prices of approximately $650 per ton, that's $130,000 to $195,000 in fuel costs daily. Over our 28-day Asia-Europe voyage, fuel alone costs $3.6 to $5.5 million. Smart operators invest in fuel-efficient engines, hull coatings, and route optimization software. The difference between an efficient and inefficient ship can be $50 million annually in fuel costs. Now let's calculate the total annual cost structure. Financing costs, $1.67 million, depreciation, $12.1 million, insurance, $3 million crew, $4.5 million, maintenance, $2.5 million direct operating costs, $23.7 million per year, total fixed costs, approximately $47.5 million annually. That's before we even add fuel costs, which vary by route and utilization. For a ship completing 12 voyages per year, fuel costs add another $43 to $66 million. So our total annual cost structure runs between $90 and $114 million. This is why route selection becomes absolutely critical. Let's compare 3 real-world scenarios using actual current market data. Scenario 1, the Asia-Europe premium route. 12 round trips per year, 28 days each. Current average rate, $3,100 per 40-foot container. With 95% capacity utilization, that's 9,500 containers per voyage. Annual revenue, $354 million, minus our $104 million in costs. Net profit, $250 million annually. At this level, the ship pays for itself in just over 1 year. But this is peak market performance. Scenario 2, normal market conditions. Same route, but container rates drop to $2,000 per box. Annual revenue, $228 million. Net profit, $124 million. Payback period extends to 2.2 years. Scenario 3, market downturn like we saw in late 2023. Container rates fall to $1,400 per box. Annual revenue, $159 million. This drops below our cost structure. The ship actually loses $5 million annually. Now you understand why shipping is called a cyclical business. But here's what separates the winners from the losers: operational flexibility. The best operators don't just run fixed routes. They constantly optimize based on market conditions. During the 2021-2022 boom, some ships were generating $100 million in profit per voyage. Companies that locked in long-term charters during that period are still benefiting today. Conversely, companies that expanded aggressively right before the market crashed found themselves with massive overcapacity and bleeding cash. The key insight is this: container ship profitability isn't just about the purchase price, it's about timing, route selection, operational efficiency, and market cycles. A $267 million ship can pay for itself in 12 months during boom times, or it can take 5 to 7 years during normal conditions. In severe downturns, it might never pay for itself. This is why successful shipping companies focus on 3 critical factors. First, they maintain diverse route portfolios, never putting all eggs in one geographic basket. Second, they invest heavily in operational efficiency, modern fuel management systems, predictive maintenance, and crew optimization. Third, they time their investments carefully, ordering new ships during market lows when shipyard prices are depressed, taking delivery during market recoveries when rates are rising. The companies that master this timing can achieve payback periods of 18 to 36 months. Those that don't can struggle for decades. But there's one more factor that's becoming increasingly important in 2024 and beyond: environmental regulations and green technology. Laser beam moves at 1,000 inches per minute and is hot enough to vaporize diamonds, yet it can cut tissue paper without burning or fout and over-inbliend. And the numbers I'm about to show you will explain why some shipping companies are swimming in cash while others are drowning in debt. Let's start with the most profitable route in the world right now: the Trans-Pacific eastbound route from Asia to the U.S. West Coast. This route has become a goldmine, with current rates reaching unprecedented levels. According to the latest shipping data, Asia to U.S. West Coast rates are now hitting $4,500 per 40-foot container. That's 3 times higher than the traditional Asia-Europe rates. Here's why this matters. The Trans-Pacific route is significantly shorter than the Asia-Europe route. Shanghai to Los Angeles takes just 14 days compared to 28 days for Shanghai to Rotterdam. This means a container ship can complete 18 to 20 round trips annually on the Trans-Pacific route, versus only 12 to 13 trips on the Asia-Europe route. Let's run the numbers on a 20,000 TEU ship operating the Trans-Pacific route. At 95% capacity utilization, that's 9,540 foot containers per voyage. 9,500 containers times $4,500 equals $42.75 million revenue per voyage. With 19 voyages annually, total revenue reaches $812 million. Even with higher port costs on the U.S. West Coast, operating expenses run about $8 million per voyage. That's $152 million in annual operating costs. Net profit $660 million annually. Your $267 million ship pays for itself in just 4.8 months. But here's the catch that most analysts miss. These sky-high Trans-Pacific rates are driven by extraordinary circumstances. The ongoing Red Sea crisis has forced carriers to reroute Asia-Europe cargo. Some of this traffic has shifted to the Trans-Pacific route, then moved overland to the U.S. East Coast. This has created artificial demand and inflated rates. Industry experts expect Trans-Pacific rates to normalize to $2,200 to $2,800 per container once the Red Sea situation stabilizes. At normalized rates of $2,500 per container, annual revenue drops to $427 million. Net profit becomes $275 million annually. Payback period extends to 11.6 months. Still excellent, but not the miraculous 4.8 months we calculated earlier. Now let's examine the Asia-Europe route, which handles the largest volume of global container trade. Nearly 30 million TEU crosses this route annually, making it the backbone of international commerce. But the Red Sea crisis has fundamentally changed the economics of this trade lane. Before the crisis, ships could transit the Suez Canal, completing the round trip in 28 days. Current rates via the traditional Suez route average $3,100 per 40-foot container. But here's the problem. Most carriers have abandoned the Suez Canal due to security concerns. They're now routing around the Cape of Good Hope, adding 10 to 14 days to the voyage. Round-trip time increases to 38 to 42 days. This extends voyage time by 50%, dramatically impacting annual capacity. Instead of 13 round trips per year, ships now complete only 8 to 9 voyages. Let's calculate the Cape of Good Hope route economics. Same ship capacity, 9,500 containers per voyage. Current Cape route rates, $30,400 per container. Revenue per voyage, $32.3 million. But with only 9 voyages annually, total revenue drops to $291 million. Operating costs increase due to longer voyage time and higher fuel consumption. The Cape route burns approximately 40% more fuel than the Suez route. Operating costs jump to $12 million per voyage, or $108 million annually. Net profit, $183 million annually. Payback period, 17.5 months. Still profitable, but significantly less attractive than the Trans-Pacific route. Here's where it gets really interesting. Some carriers are experimenting with hybrid strategies. They're using smaller, more fuel-efficient ships on the Cape route while deploying their largest vessels on shorter, high-frequency routes. MSC, the world's largest container line, has mastered this approach. They've optimized their fleet deployment to maximize revenue per TEU mile. Their data shows that operational efficiency matters more than ship size on certain routes. A 15,000 TEU ship operating at 98% capacity often generates higher profits than a 24,000 TEU ship operating at 85% capacity. Let's look at a third scenario that's gaining attention: intra-Asian routes. These shorter routes connecting major Asian ports have become surprisingly profitable. Shanghai to Singapore takes just 5 days. Current rates average $800 per 20-foot container, or $1,200 per 40-foot equivalent. At first glance, this seems much less attractive than long-haul routes, but the magic is in the frequency. A ship can complete 36 to 40 round trips annually on short Asian routes. Our 20,000 TEU ship, configured for maximum 20-foot container capacity, can carry 20,000 containers per voyage. Revenue per voyage, $16 million. With 38 voyages annually, $608 million total revenue. Operating costs are dramatically lower on short routes. Fuel consumption drops to $2.5 million per voyage. Total annual operating costs, $95 million. Net profit, $513 million annually. Payback period, 6.2 months. This explains why some carriers are shifting capacity from long-haul to short-haul routes. The return on investment can actually be superior despite lower per-container rates. But there's one more factor that's reshaping container ship profitability in 2024: environmental regulations and carbon pricing. The European Union's emissions trading system now applies to shipping. Carriers pay approximately 80 euros per ton of CO2 emitted. A large container ship emits roughly 20,000 tons of CO2 on an Asia-Europe voyage. That's an additional 1.6 million euros, or $1.7 million per voyage. Suddenly, the Cape of Good Hope route becomes even less attractive. The longer distance increases both fuel consumption and carbon emissions. Carbon costs on the Cape route can reach $2.5 million per voyage. This is driving innovation in fuel efficiency and alternative fuels. Some carriers are investing in methanol-powered ships. Others are installing wind-assisted propulsion systems. These technologies cost more upfront but can reduce operating costs by 15 to 25% annually. The payback period for green technology improvements typically ranges from 3 to 5 years. But carriers that embrace these technologies early gain a competitive advantage. They can offer lower carbon emissions to environmentally conscious shippers, and they avoid the escalating costs of carbon pricing. Here's the bottom line on container ship payback periods. In today's market, a well-positioned $267 million container ship can pay for itself in 6 to 18 months. The key variables are route selection, operational efficiency, and timing. Ships operating high-frequency short routes often achieve the fastest payback. Long-haul routes can be extremely profitable during peak demand periods, but they're more vulnerable to market volatility. The smartest operators maintain flexible deployment strategies. They can quickly shift capacity between routes as market conditions change. This agility is what separates the winners from the losers in container shipping. Companies that achieve consistent 12 to 24-month payback periods on new ship investments, versus those that struggle with 5 to 7-year payback periods during market downturns. The difference often comes down to 3 critical factors. First, route diversification. Never betting everything on a single trade lane. Second, operational excellence, maximizing fuel efficiency, port productivity, and schedule reliability. Third, market timing, ordering ships during market lows and taking delivery during market recovery. Master these 3 elements and your $250 million investment becomes a money-printing machine. Ignore them, and you risk joining the long list of shipping companies that went bankrupt betting on the wrong routes at the wrong time. So here's the moment of truth. After diving deep into the numbers, the route analysis, and the real-world operational costs, what's the actual answer to our original question? How long does it take to pay off a $267 million container ship? The answer will shock you because it's not what most people expect. Under current market conditions, the payback period ranges from 4.8 months to never. Yes, you heard that right. Some container ships are literally printing money so fast they pay for themselves in under 6 months. Others might never recover their initial investment. The difference comes down to 3 critical factors that separate the winners from the losers. But first, let me show you what's coming that changes everything. Right now, as I speak, shipyards around the world are delivering record numbers of new container ships. According to maritime industry data, over 2 million TEU of new capacity was ordered in 2025 alone. That's equivalent to adding 100 new ultra-large container vessels to the global fleet in a single year. The total order book now represents over 30% of the existing global fleet. This is unprecedented in shipping history. Why does this matter for payback calculations? Because we're heading into the largest capacity expansion the container shipping industry has ever seen. Starting in 2026, new ship deliveries will accelerate dramatically as orders placed during the 2021-2022 boom period hit the water. Industry experts predict fleet growth will outpace trade growth by a ratio of 2 to 1. This means massive overcapacity is coming, and overcapacity kills profitability. When there are too many ships chasing too little cargo, freight rates collapse. We saw this in late 2023 when rates fell below $1,400 per container. Some carriers were losing money on every voyage. But here's where it gets interesting. The smartest shipping companies aren't just sitting back and hoping for the best, they're implementing strategies that could revolutionize container ship profitability. Strategy number 1, fleet optimization through artificial intelligence. Maersk has invested over $500 million in AI-powered route optimization systems. These systems can increase fuel efficiency by 15 to 20% and improve cargo utilization by 8 to 12%. For a $267 million ship, this translates to $8 to $15 million in annual cost savings. That alone can reduce payback periods by 12 to 18 months. Strategy number 2, green premium services. As environmental regulations tighten, shippers are willing to pay premium rates for low-carbon shipping. Container lines offering verified green services can charge $200 to $400 per container above standard rates. CMA CGM launched its first 13,000 TEU methanol dual-fuel vessel in March 2025. Early customer contracts show they're achieving $300 per container green premiums. On a full ship, that's an additional $3.9 million in revenue per voyage. Over a full year, green premiums can add $47 million to a ship's profitability. Strategy number 3, vertical integration and logistics services. The most successful carriers aren't just moving containers anymore, they're offering end-to-end logistics solutions. MSC now generates 40% of its revenue from non-shipping services: inland transportation, warehousing, customs clearance, and supply chain management. These services typically have higher profit margins than pure ocean transportation. A container that generates $3,000 in shipping revenue might generate an additional $1,500 in logistics services. This transforms the entire payback equation. But there's a dark side to this story that most analysts won't tell you. The coming capacity tsunami could create a two-tier industry. Winners and losers will be separated not just by efficiency, but by financial strength. Companies with deep pockets will survive. Those without will disappear. We're already seeing early signs of this consolidation. MSC now controls over 20% of global container capacity. The top 10 carriers control 85% of the market. Smaller carriers are being squeezed out or forced into mergers. This has profound implications for new ship investments. Only companies with diversified revenue streams, operational excellence, and strong balance sheets will achieve consistent payback periods of 18 to 36 months. For the rest, payback periods could stretch to 7 to 10 years or longer. Some ships ordered during the boom years will never pay for themselves. Now, let me reveal the 3 critical factors that determine whether a $267 million ship becomes a goldmine or a money pit. Factor 1, alliance strategy and network effects. The new shipping alliances launching in 2025 are reshaping global trade patterns. The Gemini cooperation focuses on hub-and-spoke networks. The Premier Alliance emphasizes point-to-point services. Each strategy has different cost structures and revenue potential. Ships deployed in well-designed alliance networks can achieve 15 to 25% higher utilization rates. This directly translates to shorter payback periods. A ship operating at 95% capacity versus 75% capacity can reduce its payback period from 24 months to 16 months. Factor 2, future-proofing for regulatory changes. Environmental regulations are accelerating faster than most people realize. The EU emissions trading system is just the beginning. By 2030, carbon pricing could add $5 to $8 million annually to a large container ship's operating costs. Ships designed with green technology from the start have a massive competitive advantage. They avoid retrofit costs and benefit from lower operational expenses. The payback calculation must include these future regulatory costs. A conventionally powered ship might seem cheaper initially, but over its 20-year lifespan, carbon costs could add $100 to $160 million to its total cost of ownership. Factor 3, operational flexibility and market timing. The most profitable operators maintain flexible deployment strategies. They can quickly shift capacity between routes as market conditions change. During the Red Sea crisis, flexible operators moved ships to more profitable trans-Pacific routes. Rigid operators stuck with unprofitable long-haul routes saw their payback periods double or triple. Flexibility also means right-sizing your fleet. Some operators found that 15,000 to 18,000 TEU ships outperformed 24,000 TEU giants. The smaller ships access more ports, maintain higher utilization rates, and offer better schedule flexibility. Their payback periods averaged 14 months versus 22 months for the ultra-large vessels. So what's the final verdict on container ship payback periods? In today's market, a well-positioned $267 million container ship can pay for itself in 6 to 18 months. But this golden period is ending. As the capacity tsunami hits in 2026 and 2027, payback periods will extend to 24 to 48 months for efficient operators. Less efficient operators may face payback periods of 5 to 10 years. Some ships will never recover their initial investment. The key to success is understanding that container shipping is no longer just about moving boxes. It's about creating integrated logistics solutions, optimizing every aspect of operations, and positioning for a low-carbon future. Companies that master these elements will continue to generate spectacular returns. Those that don't will become cautionary tales in maritime business schools. The $267 million question isn't just about payback periods anymore. It's about survival in an industry that's fundamentally transforming. The winners will be those who understand that the real value isn't in the ship itself, it's in the network, the technology, the operational excellence, and the strategic vision that surrounds it. And for those who get it right, the returns can be absolutely extraordinary. We're talking about investments that can generate 500% to 1,000% returns over their operational lifetime, but only for those smart enough to play the game by the new rules. The age of easy money in container shipping is ending. The age of strategic excellence is just beginning.